So I've got a problem. I've got a problem with the Magnificent Seven. So I'm talking Apple, Meta, NVIDIA, Amazon, Microsoft, Alphabet, Google, and Tesla. This problem is preventing me really from doing what I think I need to do in terms of investing in the right index for me and for my pension. I've been struggling with this for a while, and what I decided to do last week is to completely move out of the world index and move into the FTSE 250 so I could really distance myself from the Magnificent Seven. Because any other kind of world index is so heavily influenced by the Magnificent Seven because there's such large companies in terms of their stock value that any dip in any of these seven will have a massive impact, whereas the FTSE 250 would remain relatively sheltered from that. Okay, so let me go back. I need to do this. I need to go back to 1999 to tell you where I think this problem started. So back then, I had a specialism on it, and that was around web metrics. So this was telling the difference between what was commonly used then, which was a hit. So back in 99, everyone was talking about hits on their website, to something a lot more formalized. So I was taken on a PwC because I was a specialist in web metrics. And one of the first assignments I did back in Jan 99 was for the Advertising Bureau of Circulation. So these are the guys who determine how many papers are sold, how many radio and TV shows are broadcast, that kind of thing. And they wanted a definition, a proper definition for how we measure people who visit internet sites. So we were getting rid of hits, and we were talking about unique visitors, and we were talking about page impressions and all the kind of metrics you may have heard of now, because there was no proper definitions back then. And if you think about it, if you were investing in the stock market in early 1999 and you wanted to value a new .com company, well, there was no financial measures. They'd only been around 6 months. They didn't have a financial history. You couldn't go and pull out last year's balance sheet or the P&L and have a look through it. So one of the things that people did to value a company back then was to look at its web metrics. And what they were all publishing back in early 99 was their hits, which was absolute gobbledygook, really. It didn't mean anything in terms of whether the people were visiting their website or not. So this assignment, what I had to do was come up with some formal definitions for a page impression and a unique visitor. And the idea being is that when a company listed on the stock market, it was required then every month or every quarter to produce a set of metrics based on whether their website was growing or shrinking. And from doing this work, so me and the team worked on most of the big .com flotations back in 1999 and early 2000s as well. And what we used to do is go in and do an audit on them. So we'd audit their numbers, and we would then produce a set of web metric accounts, almost like financial accounts, but looking at their kind of visitors to the website, whether they were growing or not. So from this work, I could see that the valuations for some of these companies were just ridiculous. And I was quite nervous at the time. There's no way you'd have had me investing in any of the companies that were listed on the stock market by then, because I could see that a lot of the foundations of the company were built on nothingness, really. There was no profitability. There was nothing solid in the foundation for these companies. And actually, the numbers that people had started buying shares based on the web metrics weren't true. So we knew once we started generating an auditing published set of numbers for their IPOs that investors would have better information at that point. And lo and behold, you had a massive crash, huge reduction in the share prices of these companies. I think that has always lived with me, that crash, that the fact that, in some way the team and I that were working on this, going around different countries and measuring and reporting on web metrics had an influence on whether investors will buy or sell these shares, and the massive crash that came after that. It does live with me, and it still lives with me. And now when I start looking at the Magnificent Seven, I can see some patterns. I can see some similarities to back to the time in 1999 when I was doing this work. And I think the AI boom, in some ways, for me, is similar to the .com bubble back in 99. So I'll tell you why I think it's similar. Back in 1999, everyone knew there was massive potential in the internet, absolutely massive potential, but no one quite knew what it was. So investors were saying, we know that the internet's going to be a big thing. And actually they were right. It is a big thing. Just in 1999, it wasn't mature enough. People didn't know why it was the big thing. And therefore, between mid 2020 and 2022, the markets fell through the floor because people hadn't quite worked out what the internet was, how it would be monetized, and how it would change all our lives. Okay. I think there's something similar now going on with AI. Okay. Don't get me wrong. AI is going to change the world. It's going to be massive. However, I don't think we as a population on this planet yet understand how and why. And my fear is that the stock markets are reacting massively to the potential, but not knowing how that potential converts itself into profitable businesses yet. And you may see, like you did back in 2000, 2001, 2002, a dip, which is just a time-bound dip, until we as a population of this planet work out what AI is for and how it's going to change humanity in the way that the internet has. Okay. Now, there's also another thing, particularly about Magnificent Seven. I'm going to go back to 6 really, because I'm not counting Tesla. I'm not counting Tesla because for me, Tesla has been an amazing company, and what they're doing is putting all their money into research to come up with the perfect electric car. And then you've got GM and all the massive big companies sitting in the background, letting them spend their money investing in this new technology and working out what the future looks like. And then they're going to move in. The research has now been done. It's saved them a few £100 billion, and they'll move in and take markets off Tesla. So I'm not counting Tesla. I would never invest in Tesla. The other 6, though, I think there's some cannibalization possible with these 6 if you think of them as a group of 6. Okay, so let's take AI as an example. So I might be wrong. Google might really grasp AI with Bard and there's some of the new technologies and have a massive market share develop around AI. At what cost? So Microsoft have massive AI. I use Copilot every day. If Google take a massive amount of the share, where does that leave Microsoft's AI future? And also Facebook, Meta, they're also launched massive AI products recently. They may take the market, but if they do, are they going to be taking markets off Google? Are they going to be taking markets off Microsoft? So I do believe there's huge amounts of growth. And if you look at any one of these companies, I can see where that growth comes from. But if you put them as a pack of 6 and think about where their investment's coming from, then I see so much cannibalization. It just makes me nervous. So that was AI. Let's think then about maybe Google, where it's got its massive Android ecosystem driving mobile phones. And mobile phones are just ubiquitous. Everyone has a mobile phone now. It's and we spend so much time on them. But so do Apple. So if Apple take a massive amount of new share with their iPhone, how does that leave Google's with its Android? Does that mean they're going to drop? And if Google take a massive amount of the share, how does that leave Apple? So you can see what I mean about cannibalization. They're kind of feeding off each other. And although individually they have massive potential, I do feel there's some impact they will have on each other. Okay, so we've talked about AI, we've talked about the mobile phone infrastructure. Let's talk about cloud. So Google has massive servers and massive services in the cloud, and you can go and use Google services, use Google Cloud services. You can also go to AMZ, Amazon, and they get so much of their revenue from their Amazon Web Services, AWS, that it's incredible. And then you have Microsoft as well, with the huge amounts of revenue that's coming out of their cloud services. So undoubtedly, cloud services will continue to grow. But what I'm nervous about is Microsoft take a huge amount of that share. Will that reduce the value of Amazon with the Amazon Web Services? Will it reduce Google cloud-based services as well? So again, there's 3 things where they're all cannibalizing each other, even though they're being grouped together as this group of 6 companies, which are having such a massive impact on all of our pensions. So if you've got a work pension here in the UK, and them 6 take a tumble next week, then you will lose massively unless you're self-invested and you're avoiding the US market somehow. Maybe you're focus just on Asia or just on Europe, but even if just on Europe, you'll still feel an impact. And I struggle because really I want to be in the world ETF because it's the most diversified. But when you actually look what that's built up of in terms of value, then we can't ignore that the Magnificent Seven have such a big number. If they take a massive tumble, then the world index is coming down with it as well, which is why really I moved out of world stocks and into the FTSE. I mean, I mentioned in my last video, there was also the Labour manifesto, which said that they're going to persuade companies to move into pension funds to favour the London Stock Exchange. Not sure that'll ever happen, but that kind of goes some way to explain where I am in terms of my nervousness for getting into the world index. And I do blame the Magnificent Seven for the way I feel and just how I got there in terms of 1999 and the crash, which I was part of and lived through as well. So I've recently set up on Buy Me a Coffee. So if you are enjoying these videos and you do fancy buying me a coffee, please have a look in the description below where you'll find the link. Thanks. So if you've heard my outro, then thanks for listening. And if you haven't, then here's probably the most important bit of investing advice you'll hear on YouTube. Don't buy or sell shares in a company based on what someone on YouTube tells you. The big Wall Street analysts have large teams of professionals with access to vast amounts of data on every single listed firm. There are no YouTube gurus who know better than them. Use YouTube to find interesting bits of information on companies that you may otherwise miss. And when you find something interesting, do your own digging and see what the analysts in the big firms are saying. Never invest more than you can afford to lose and don't expect to get rich quick. If you are interested in my background, I come from 16 years in risk management with PwC and Deloitte. I've never been on a trading floor in my life, but if I had, it wouldn't give me the edge on the big firms because they have big teams and masses of information. So don't look for a guru with an edge. Look for information on companies you're interested in. And if you're looking to invest a large amount of money, don't put it on individual stocks. Choose an index fund. The All World Index is a representation of all the stocks in the world. And if one company goes broke, then the index won't even move. Whereas if you've only invested in that one company, then you may have just lost your pension. Keep it fun, keep it affordable, and subscribe to keep getting my updates. Thanks.